In this video, we are going to discuss merchandising industry, merchandising company. What is merchandising company? We already know. How? Because we shop almost every day. Walmart, Canadian Tire, Fresco. They are all merchandising industry. What's their nature of business? They purchase, they buy their inventory and sell. Buying and selling, margin between both, that's how they generate their profit. That's the nature of business. That's a little bit different from service industry we've been talking about. Service industry, we don't need to buy anything to sell because we provide our service. We sell our skill. Merchandising industry is different from manufacturing industry as well. Manufacturing industry, they have to produce and then sell. So different. Merchandising industry purchase finished goods and then sell to the end users, like you and me. So, in order to discuss new industry from the service industry, we need to discuss several new concepts first, new terms, new vocabularies, which is this. Very, very important concept. Cost. What's cost? Cost is a little bit broader and wider, bigger than just the expense. Let's say somebody posted this cell phone on Kijiji for sale. So I think I can buy this one and sell to the other customer. Then I expect some margin between. The seller posted the cell phone price as $200. So cost and product cost is the same now. But seller, the one of the condition is I need to pick it up. So I have to take TTC twice. Then $6, let's say $3 for 1 day. Also, I think I need to spend at least 1 hour for this one to pick it up. So let's set up only minimum wage. So $221. When we say cost, cost is not just $200 for this product cost. Have to include everything. So cost of product, that's how we define. Total amount we paid until goods are ready for sale on the shelf. So total amount. That's what we call cost of product. Good. Second, inventory. What's inventory? Goods we purchased only for sale, to sell. If we purchase goods for use, like equipment, like machine, that's not inventory, as you already know. Goods we purchase to sell. Let's talk about this one, car. If we are a variety store, so I use this car for delivery, then definitely that's a long-term asset, right? That's not inventory. But what if we are a dealership? What's the major business activity? Selling cars. So they purchase car for sale. Then, in that case, car is inventory. Okay. Good? So, cost and inventory, those two brand new concepts are going to affect on your major financial statement. Income statement. Income statement, we record revenue and expenses. So, as we already know, we have operating expense. We have to pay salary for our employees. We have to pay for rent, right? We have to pay for depreciation. Those kind of operating expense we already have under service industry. But because of the nature, as I mentioned before, we have to purchase inventory. Purchase first and then sell. So when we purchase, nobody's going to give you for free, right? So we have to pay product cost. The name of product cost we call cost of goods sold. So under merchandising industry, we have two types of inventory. One for business running, one for product. When we were service industry, we didn't have this one, right? Only operating expense. Then, what about inventory? Oh no, inventory, balance sheet. That's cost of goods sold, cost concept. Inventory, we have to classify as what? Current asset under SSI. Why? Because why we purchase the inventory? For sale, to sell. We expect to sell inventory within an operating cycle. Based on that definition, we must classify inventory as what? Current asset. Okay? So, cost concept, cost of product concept, and inventory concepts are really, really crucial under merchandising industry. We must know that well. But I can say the most important concept under merchandising industry, that's this. I'm gonna use red one. Point of view. What's point of view? Because of the nature of merchandising industry, as I said, we have to buy and sell. It's not separated. I have to buy product from the manufacturing industry, and then sell to you, right? So, based on the nature, I am buyer. That means I have to record accounting record as a buyer's point of view when you are buyer. Then at the same time, when we sell, we must change our point of view as a seller. So the accounting record should be recorded as a seller's point of view. So you have to change. Buying as a buyer's point of view, you record. Selling as a seller's point of view, you record. It's not separated. You buy, sell, buy, sell, buy. You have to change your point of view based on your situation. If you just mess up your point of view, you're going to produce wrong accounting record. wrong and nonsense records. You're gonna produce nonsense financial statement because of this. That's the point, key point of merchandising industry. This concept is going to kill you. This is going to drive you crazy. We gotta be really, really careful with this concept point of view. Okay? So what's our major concern as an accountant for merchandising industry? As an accountant, we need to record. How did we define accounting, language of business, and also transaction, recording, and communicate by using this record. So we have to record. How we record cost of goods sold and inventory for merchandising industry. In general, we have two inventory systems. Periodic inventory system and perpetual inventory system. Periodic inventory system, that's classic one. That's very old one. As you can guess, we record and update our level of inventory and cost of goods sold in periodically. So whenever we need to. Usually end of month, end of quarter, end of year, just before we produce financial statement. So that's a classic one. That was popular in the past. Then, perpetual inventory system. Periodic just occasionally. Whenever we need, right? Perpetual means what? Real time. We update level of inventory and level of cost of goods sold in real time. How? Because now we have technology, that means computer system, barcode system, make this happen. Let's say you purchase goods at Walmart. When you pay cash to cashier, they just scan. What they are doing? They are going to charge how much you're gonna pay, right? Based on at the same time, they just decrease their inventory. So that's how you can ask them if they have other branch more inventory in real time. Because of technology, this is possible. Now this is more popular, as you know. So we're gonna discuss perpetual inventory system first, and then periodic inventory system. I'm going to introduce the basic concept, not how we record every single journal entry in detail, maybe in the future. Okay?